Hello, finance experts. This is Matthew Wright, and this is my Finance 451 Summer 2019 Bloomberg Analysis Project. So, for this project, I analyzed two industries over 5 years and analyzed five companies within each industry. I analyzed these companies using short and long term solvency measures, asset management, profitability, and market value ratios. My goal in this project was to identify the best company in each industry and the best overall company. My first industry that I chose was the restaurant industry, and the companies I chose within each industry was Wendy's, Papa John's, Chipotle, Domino's, and Carol's. So I started off with the short-term solvency measures. In Wendy's, I found that the cash and inventory are driving their current ratio. Wendy's is liquid in the short term, and their ratios indicate they are attempting to use their money to earn returns in the short term. All three of their short-term solvency ratios are all correlated and drivers into their current ratio. In Papa John's, I found that their current ratio indicates that they're liquid despite it decreasing over the past 5 years. All three of their short-term solvency ratios fall below the industry average, and they do not possess a lot of cash to cover their short-term liabilities. Moving on to Chipotle. 5 years ago, Chipotle was very liquid in all three ratios, being well above the industry average. Over the past 5 years, they have cut these ratios roughly in half while still maintaining liquidity, implying that they have done a better job utilizing their assets over the years rather than just sitting on them and have earned returns on them. Domino's current ratio indicates they are liquid in the short term. However, a low quick ratio and an even lower cash ratio indicates that their inventories and cash are slim drivers of their current ratio, as they do not have a lot of cash on hand. Carol's short-term solvency measures do not come out being very liquid. However, their liabilities outweigh their assets. So they do not have a lot of cash on hand. Here I have graphs for each of the three, and you can see the Chipotle's decrease, but they have become stable over the past couple of years. And the quick ratio and the cash ratio can show the same as well. Moving on to long-term solvency measures, starting with equity multiplier. As you can see, Wendy's equity multiplier indicates that they have been increasing the amount of shareholders' equity to finance their assets, which is higher than the industry average and shows they have high financial leverage. From 2014 to 2016, Papa John's was using more than the industry average to finance their assets with shareholder equity. From 2016 to 2017, they changed from 28.07 to negative 5.6, implying a large portion of their shareholder equity was financing their assets, to now essentially no debt is now financing their assets. Chipotle has a consistently low equity multiplier, which indicates that they are heavily reliable on equity financing and do not rely on debt. By doing this, they avoid high servicing costs and are way more favorable with low risk. Domino's equity multiplier indicates their ability to not rely heavily on debt and more so on shareholder equity. Carol's equity multiplier is pretty consistent with the industry average, which indicates that more of their assets were funded by debt than by equity. Moving on to the total debt ratio. Wendy's total debt ratio was below the industry average, however, it is still relatively high considering the large amount of Wendy's total debt relative to their assets. Papa John's total debt ratio has consistently increased over the past 5 years above the industry average, showing the proportion of the company's assets that are financed by debt. Chipotle does not have any debt that they currently account for, so they do not have a total debt ratio. Domino's total debt ratio indicates that they possess very high financial leverage, as you can see here, as they are clearly way above everyone in the industry. Carroll's total debt ratio once again shows their dependence on debt to finance their assets, despite them being below the industry average. Moving on to debt to equity. Wendy's debt to equity shot way above the industry average, indicating that Wendy's became more dependent on debt financing rather than equity financing. Papa John's equity multiplier soared over the industry average. However, they did not have any calculations for 2017 or 2018. But they did start relying more on equity than on debt over the past few years. Chipotle does not have any debt to equity, as they do not possess any debt. Domino's debt to equity is also absent. And Carroll's debt to equity shows that they are very heavily reliant on creditor financing rather than equity financing. Now moving on to the times interest earned ratio. For Wendy's, they fall below the industry average and have been steadily decreasing, indicating they are not making interest and debt service payments, as they are not putting a large amount of their income into paying off future interest expenses to pay off for the future. Papa John's times interest earned decreased annually under the industry average in 2018. This consistent decrease indicates that Papa John's may be leading towards not being able to meet their debt obligations. Chipotle does not, once again, have a ratio for this, as they do not have any debt obligations. Domino's times interest earned is slightly below the industry average, however, is still high enough to assume they are profitable enough to make interest expense and debt service payments. Carroll's does not have very favorable times interest earned ratios, but they are acceptable. They are still positive, but they fall below the industry average. Now moving on to asset management and looking in asset turnover. Wendy's asset turnover ratio indicates that they are not efficiently utilizing their assets to generate sales, which can be due to management problems or production problems, as they are the lowest, or one of the lowest in the industry. It appears as if Papa John's is efficiently using their assets to generate more sales, as they are producing roughly $3 in sales for every asset and for every dollar invested in assets. Chipotle worked their way up to the industry average over the past couple of years, which indicates they are just about at the industry average for their production of sales generated from their assets. Domino's, which has very impressive numbers, shows that they are very effectively generating sales from their assets. Carroll's meets at about right the industry average for this category, showing they are efficiently generating sales from their assets. Moving on to profitability ratios, starting with profit margin. Wendy's profit margin increased substantially over the past 5 years, well above the industry average. These numbers indicate Wendy's successful operation of turning sales into net income. Papa John's appeared to be officially turning sales revenue into net income all the way up until 2018, where their ratio tanked due to a major decrease in net income. For Chipotle, despite the volatility and the one-year outlier in 2016, Chipotle's profit margin is a strong indicator that they are able to generate net income out of their sales revenue. Domino's profit margin consists of the most consistent and upward sloping ratios in the industry. They are well above the average and a good sign of them effectively turning sales into net income. Carroll's numbers are relatively concerning considering the volatility and low percentage of sales contributing towards their net income. Moving on to return on assets. Wendy's has improved their ROA over the past 5 years, indicating they have done a better job in allocating their assets to generate income. Papa John's, despite in 2018, where they had their severe net income decrease, their ROA has been substantially good, showing they have been effectively using their assets to generate earnings. Despite the drop in 2016 for Chipotle, they normally average at about the industry average in their returns on assets. Domino's, as the clear number one in the industry in this category, is they nearly double the industry average and are earning the best returns to generate earnings for their company. Carroll's, on the other hand, seems to be all over the place, and it appears as if their management is having trouble utilizing their assets to generate earnings. Moving on to return on equity. Wendy's suggests that they have improved their profitability by generating more profit by using shareholder equity. Papa John's, which only has values for 2014 and 2015, looked very good. However, not having any calculations for 2016 and beyond may be a little concerning. Chipotle has good numbers despite 2016, and it shows their ability to generate profits while utilizing shareholders' equity. Domino's does not have any outputs for this category. Carroll's numbers are troubling, but recent years may hint at a potential stability and growth opportunities. Moving on to market value ratios, starting with price earnings. Wendy's falls below the industry average, but they are still making substantial earnings per share based on what the market is paying for its stock. And they do have very consistent numbers in this ratio. Papa John's is also below the industry average, but they are still making substantial earnings per share based on what the market is paying for its stock. Chipotle averages about the industry average, with a big boom in 2016 due to a significant drop in their earnings per share due to a major decrease in sales from their famous E. coli outbreak. Despite this tragedy, they still were able to bounce back and maintain their above industry average ratio the past 2 years. Domino's has been very consistent, however, they still fall below the industry average, as they are not producing the same earnings per share that the other companies in the industry are paying. Carroll's has decent numbers with higher earnings in 2016 and 17, where they are able to produce higher performance and showed signs of potential growth. Moving on to economic value added. Wendy's is significantly below the industry average, consistently shows that they are not generating values from the funds that are being invested into their business. Papa John's numbers were very consistent with the industry average despite a sudden drop in 2018. Chipotle's big boom from 2014 to 2015, then a significant drop in 2016. However, they had a slight increase after it, but typically are generating value from the funds being invested into their company. Domino's was significantly above the industry average, as they are one of the best in the industry, and generating value from the funds being invested into their company. Carroll's numbers are very volatile, hitting both sides of the spectrum, while this shows very inconsistent use of the assets being invested into their company. Lastly, we'll look into the firm's enterprise value. Wendy's nudged their way up to the industry average over the past 5 years in enterprise value, and their company is worth about as much as the industry average. Papa John's company is valued very highly, but it is not competing in this component's industry average. Chipotle has been consistently high and well above the industry average, and they have a very appealing company to investors. Domino's was also able to maintain their enterprise value above the industry average, which infers that they are doing a very good job with their assets. Carroll's as well is below the industry average, but they have consistent outputs, which is a good sign. So this leads me to the best company in this industry, which I believe was Chipotle. They were able to manage their assets efficiently in the short run. They used shareholder equity to finance their assets, and in return, they received efficient and very consistent profitability ratios. Moving on to my second industry, the beverage industry. The companies I chose for this industry are Anheuser-Busch, Molson Coors Brewing Company, Constellation Brands Inc., Boston Beer Co., and Craft Brew Alliance. Starting with short-term solvency measures. For Anheuser-Busch, their current ratio shows that the firm is not liquid and below the industry average for solvency measures. Looking at Molson Coors, they are also below the industry average and do not appear to be liquid in the short term. Looking at Constellation, they do appear to be liquid and are also above the industry average. In Boston Beer Company, they are the most liquid company in the industry and have very good solvency measures. Craft Brew Alliance is also liquid and also appears to be above the industry average. Looking at the quick ratio, it is very similar to the current ratio, and it is able to show what numbers, if inventory is driving the current ratio, and also looking at the cash ratio, it helps to help you figure out what is driving the numbers in the current ratio, if it is cash or if it is inventories or other receivables. So now moving on to our long-term solvency measures, starting with the equity multiplier. Anheuser-Busch is above the industry average, which shows a higher percent of their assets were funded by debt than equity. So they are a high risk and highly leveraged company. Molson Coors increased to about the industry average with how much of their assets are funded by debt over equity. They are also a high risk and high leverage company. Constellation is very consistent, and they are above the industry average, which also shows the high risk and high leverage associated with them. However, Boston Beer Co., on the other hand, uses less debt to fund their assets than the industry average and are more favorable and less risky due to their use of due to their minimal use of debt. Craft Brew Alliance is below the industry average, showing less risk and leverage and more funding coming from investors rather than creditors compared to the industry. Moving on to the total debt ratio. Anheuser-Busch, compared to the industry average, they are taking on more debt to finance their activities than other companies in the industry. Molson Coors also is above the industry average as they have been taking on more debt over the past years. Constellation, as well as these other two, are also taking on a lot more debt to fund their assets. However, Boston Beer Co., on the other hand, is barely using any debt, if any at all, to fund their assets. Craft Brew Alliance is increasing towards the industry average for how much debt they are using, but they are still below the industry average for now. Moving on to debt to equity ratio. Anheuser-Busch uses more than the industry average amount of creditor financing rather than investor financing, which is considered more risky and pricey than investor financing. Molson Coors increased above the industry average, taking on more risk and more debt. Constellation has a higher debt to equity than the industry average, also symbolizing high risk and more debt obligations. Boston Beer Co. is outperforming this entire industry with their debt management. They are using significantly less debt compared to equity to finance their assets. Craft Brew is using less debt to equity than the industry, but still has a considerably larger amount of debt than equity, possessing a small amount of risk. Moving on to the times interest earned ratio. Anheuser-Busch has decreased their times interest earned ratio below the industry average. However, they're still producing enough pre-tax earnings to cover its interest expenses about 4 times. Molson Coors is at about the industry average, showing that they are able to cover interest expenses in the short term. Constellation worked at about the industry average, suggesting higher pre-tax earnings, showing they can pay off interest payments to potential creditors. Boston Beer Company did not have a ratio for this one, as they do not have any interest expenses. Craft Brew Alliance was very volatile, but should be able to pay off creditors. Also, a low amount of debt is being used by them. Now moving on to asset management and asset turnover. Anheuser-Busch is below the industry average, and it appears as if they are not efficiently using their assets to generate sales. Molson Coors is also below the industry average, and they are not generating sales from their assets that are being invested. Constellation is relatively low, however, their numbers are consistent, showing they are managing their assets well, but they could be using them more effectively. Boston Beer Company is the best in the industry in asset turnover, as they are well above the industry threshold, and it appears as if they are generating the most sales from their assets being invested. Craft Brew Alliance is above the industry average and the clear second best company for this ratio, as they are doing the best job in turning their assets into sales. Moving on to profitability ratios, starting with profit margin. Anheuser-Busch started above the industry average but progressively decreased with volatility. This suggests that they are not producing consistent sales. Molson Coors averaged above the industry average but have not done a good job producing net income out of sales. Constellation has been increasing their profit margin over the past 5 years and have been more efficiently turning their sales into net incomes. Boston Beer Company was slightly below the industry average, but had consistent enough numbers to know that they're doing a good job of managing their expenses and sales. Craft Brew Alliance was well below the industry average, and it could be some signs of unexpected expenses or low sales volume. Moving on to ROA. Anheuser-Busch is not receiving the same returns on assets as the industry. They are not turning their assets into net income or profits, which could be a sign for their company. Molson Coors is also below the industry average, and they need to figure out how to get better returns. Constellation is consistently increasing returns from assets, showing they are effectively managing and utilizing their assets better on a year-to-year basis. Boston Beer Company is well above the industry average, so they are receiving the best return from their invested assets. Craft Brew Alliance has relatively inconsistent and low returns from assets. Moving on to ROE. Anheuser-Busch has decreased below the industry average due to an increase in debt and decrease in equity funding. Molson Coors' return relative to total equity each year has been consistent with how much equity they have been using to finance their assets. Constellation has consistently been increasing and has resulted from better utilization of equity and a slight decrease of it as well. Boston Beer Company has been consistently above the industry average, and equity and incomes remain constant along with their returns. Craft Brew Alliance has low and volatile numbers compared to the industry, and they do not appear to have good returns on equity. Moving on to market value ratios. Starting with price earnings. Anheuser-Busch has relatively consistent numbers that are slightly below the industry average, with one outlier due to a significant decrease in earnings per share in 2016. Molson Coors has volatile numbers caused by a peak in 2016 where the stock reached its high and earnings per share were at their best. Constellation has been due to earnings per share growing at a faster rate than price per share. The changes in the PE ratio for Boston Beer Company are due mainly to fluctuating stock prices over the years, which hints at a higher performance and growth for the future. Craft Brew Alliance was way above the industry average and is very fluctuating. Moving on to the market to book ratio. Anheuser-Busch is at about the industry average, but it is still valued more than the other companies relatively in the industry. Molson Coors is below the industry average, but is still valued at more than its book value says it is worth. Constellation grew slightly above the industry average, now being valued at more than other companies in the industry. Boston Beer Company has been decreasing, but is still above the industry average as it is the highest valued company in the industry. Craft Brew Alliance is below the industry average, but still valued more than its book value. Moving on to economic value added. Anheuser-Busch had a big transition from a positive EVA to a heavily negative, which shows that they are not generating value from the funds that are being invested into their company. Molson Coors worked at about the industry average, showing they are creating more value for their company. Constellation, which has the most consistent and positive numbers, suggests they are efficiently creating value for their company. Boston Beer Company is consistently above the industry average and has very consistent numbers, showing that they are creating value for their company. Craft Brew Alliance, despite their negative outputs, they still lie above the industry average as they are creating more value in the industry than others. So now this brings me to my best company, not only in the industry, but also overall, out of all the companies I analyzed, which was Boston Beer Company. They were not only the most liquid firm in their industry, but they also did the best job at funding assets purely from shareholders' equity, and they did a good job of driving sales from their assets, and they are one of the most efficiently profitable companies in the entire industry.